It's like it can amplify.
So you use $1 of your own, $9 of borrowed money, and you
Yeah.
make $5. So you make 10% of $10 instead of 10% of $1.
Yeah.
You've leveraged your money and got it working. It's like a multiplier.
It's actually a money multiplier.
Sorry?
It's like the money multiplier.
Yeah, it's like a multiplier. Okay, so great.
Basically what happens...
Sorry for interrupting.
It's all right.
I'm not supposed to interrupt.
Basically what happened in the derivatives market now is people are using the leverage to invest in the financial derivatives. So since the risk of the derivatives are very high, the effect of the leverage will amplify that risk.
I understand that. So that you can make a lot of money. On the other hand, you can lose a lot of money.
Yeah.
And if you lose a lot of money and it's on borrowed money, then you're up the creek because you can't pay back. And then you fail. And you're complete. Okay, that's interesting.
And also because of the contract is not very, should not allow be published. So the lack of transparency in this market will give the dealer of it during the exchange have a large chance to have a very high spread, very large spread to make money.
Yeah.
So
Or lose money.
Or lose money. But basically, because they are in the advantageous side in the trade, they have more information. So basically, they are making money, and the investors are facing higher risk.
As a friend of mine once said, a hedge fund is a black box. You haven't got a clue what's going on. And they don't have to report.
Yes. So the leverage of the capital is not a very good sign in derivatives market can be used for the negative side as the evidence to say there should not be regulation.
So you're basically saying because the risk of losing money is so high, the probability is so high, we should regulate it to
Yes.
decrease the risk?
Yes. To control the
Okay,
risk.
now why should we do that? You know, the bigger you are, the harder you fall. So if you take a big risk and you lose, you lose. The only problem is bailing them out. If you don't bail them out, then there's no problem.
Yes, but actually, it will work.
There's no moral hazard if you don't bail them out.
Can you say that again? Can you say it again?
But regulation.
There's no moral hazard if you don't bail them out. You
But
lose, you lose.
that's what I'm going to say next.
Okay.
So, the third, okay, I will
Sorry for
say
interrupting.
earlier. The third argument is about the moral hardship because they are too big to fail, so the government will bail them out anyway. But actually, it's not problem rooted by the government regulation because regardless of whether there is regulation in the market or not, the government will bail them out anyway. For example, the latest example is the liquidity crisis happened in China last year. In June last year, the overnight rate in China was pushed up to over 13%, which is a historical high record because the shadow bank industry in China lacked government regulation and the banks put too much capital into that industry.
Okay.
And when the industry collapsed, the government had to bail them out.
So just out of curiosity, if you had some kind of rule that said, or some kind of trust that the government would not bail you out, would that resolve the regulation problem? If you knew that the banks would not be bailed out, would you still want to regulate?
What I'm trying to say is the problem of bailing out or this moral hazard is not a problem caused by the government regulation. It's caused by maybe the monopoly in this market because they're already too big.
But if I go to Las Vegas and I bet $1, I have a great chance, for me, a certainty of losing $1. If Professor Malhotra goes to Las Vegas, being the gambler that she is, and she bets $1,000, she probably has exactly the same chance of losing $1,000. What's wrong with that? She's taking the risk. She has a chance of losing $1,000. I take a risk. I have a chance of losing $1.
Yes, but if someone
So-
took away my $500, then I won't be losing 1,000. I'm losing 500.
Say again?
If someone took away my $500, right? If my husband says, "Hey, 1,000,
You can only take
I hold
500 to
500 and you
Vegas.
hold 500,"
Yeah.
then I only lose $500, right?
but that's my point though. You stand to lose whatever you gamble.
right?
And so if I gamble on derivatives,
If I only lose $500 and those $500 were actually being paid to a lot of people who are working for me, then I have now only lost wages of 500 people instead of 1,000 people.
okay, but let's do it simply.
No,
Let's do it
let's
simply.
get to the end of the discussion.
Well, I'm going to,
500 instead of 1,000 people, right?
my end.
Now you're saying that if you don't pay those 1,000, if you say I refuse to help you pay those 1,000 people, then I won't really be putting that 500 into that risky investment, right?
That's
I won't
right.
be gambling with that,
That's
right?
right.
But those 500 aren't yours.
Yeah.
You're gambling with other
Yeah,
people's money.
That's the whole point of the
That's the whole,
derivative.
that's the whole point, right?
Yes.
No, but as
Okay, but
the
what-
borrower of
So
the
now,
900.
if now whether the $500 were taken from me or not, right? Now we have two people, you were gambling. Right, so
That's my
she,
bus buddy.
should, no one took,
I don't
no
know her
husband,
real
right?
name, but I
No.
know her.
no husband, so no husband took $500
Well,
away
we
from
don't know
her.
if she has a.
I don't. So no $500 taken away from her, and she spends $1,000, and so the wages that she was going to pay, $1,000 wages she was going to pay, has been lost. 500 wages lost, $1,000 wages lost. Now the government, whether it decides to bail me out or bail her out, has nothing to do with the fact that I was regulated and she wasn't. There's no correlation. She's saying there's no correlation between bailing out and whether you restrain someone from taking that risky investment.
I'm going to Vegas and I want to bet $10. Gamble $10. I've only got one of my own. I borrow 9 from this handsome gentleman in the white shirt, whose name is who? Trump. So I borrow 9 from him. Now I've got 10. I've leveraged my money, right? And I go and I bet. I know that I have, let's just take a silly example, a 10% chance of winning. I have a 90% chance of losing. In fact, I'm probably going to lose that money. Which means I know I'm going to have to pay this guy back. I know the risks up front. It's got nothing to do with, the problem comes when you start bailing me out and you say to me, oh, Gateman, if you lose, don't worry, Dad'll pay. That's where the problem comes in. So I'm saying, if Dad doesn't guarantee my losses, and I know I'm going to have to work to pay Pat Trummer's $9, I know that before.
What if Daddy had no option? He loved you so much that he had to bail you out, irrespective of what you did. And what can Dad do? What Dad can do is make sure that you don't borrow that $5.
Well, do you know that though?
No,
Yeah,
what
I
I'm
know,
saying
Dad can't help
is,
it.
what I'm saying
Dad
is
is
the
not
government
so
should not love you.
The government does.
Not my government.
What is government's welfare
The
function?
government just takes.
The government's welfare function is to be
Love you?
voted again. No, to be voted again. And to be voted again, you have, oh sorry, you have.
It's okay, don't keep. I'm not letting you off.
Albert, stop interrupting.
You.
Yeah.
Okay,
One point I
so here's my,
I should probably go sit with them.
so you're arguing that derivatives should be regulated.
Yes.
And my question to you is this: if you don't have a bailout system, why bother? There's no problem. You don't need the necessity. You don't need the requirement of regulating.
The thing is, bailing out in our definition does not belong to a government regulation. Bailing out is not a regulation.
Assuming,
It's the government
okay, let
has
me put it to
do
you this
something.
way: assuming no bailouts.
Yeah.
Assuming no bailouts, if you are 100% certain that the government does not love you, do you still need regulation?
Yeah,
Why?
that's another point.
Yeah, go ahead.
Good, let's do it.
So, if there is no bailing out, the government regulation is still necessary because based on currently what is happening, the derivatives market is going to be a monopoly. Actually, according to the survey made by Financial Times last year, more than 87% of the assets managed by the hedge funds are controlled by less than 5% of the hedge funds. And the starting up hedge funds are facing a very strong difficulty to raise capital and to manage their assets very well.
Okay, with due respect, not to interrupt and be very nice and gentle. So what?
So if there is a monopoly, the market is not efficient at all.
Is it actually a monopoly?
Okay, that's a good point.
Or-
I'm going to turn it to a
More
minute.
likely to go into the.
So you're rebutting. I would love to hear your rebuttal of, are you? Who are you?
I'm gonna
You're Paige, what's your first name?
pay Joe.
Oh, Paige. Okay.
No.
So, would you like to?
I just want to say one thing quick and then he'll take it away. However, is this really an issue of like having a monopoly in the marketplace? Is the derivatives market, let me say this, is having let's say five big six firms, is that actually a monopoly if you're trading these contracts with other people's money that intertwine around the world? Is that a monopoly in a sense? Does that change the asset prices?
Yes.
It does. So why would that, when we're done here, I'd like you to get back to that. How does that change the asset prices? Why does it change the asset prices? Because the derivatives are contracts based on the underlying asset. So when you're talking about a monopoly in big firms on something that's derived out of the prices, I just don't understand how that's a monopoly that creates inefficiencies, because you're talking about not just one firm producing one thing for everybody. You're talking about, sure, one firm producing many different types of contracts of asset prices, of other people's assets, of commodities, of futures, of currencies around the world. So I don't think that would be a monopoly, but
Is the variance of the risk of a derivative higher than the variance of the risk of the underlying asset?
well, that's the beauty of derivatives, is that you can create higher risk.
Is the variance of the risk of the derivative higher than the variance of the risk of the underlying asset?
You could almost
Yes
put
or
it to
no?
infinity, so yes.
The answer is yes.
Yes.
Are you talking about the mean or are you talking about the variance in score?
Talking about the variance of like returns on derivatives. I'm assuming.
Not just the mean.
Pardon?
You're not just talking about the mean, you're talking about the variance in score.
Yes.
So I just wanted to address firstly the transparency argument of transparency protection. We agree absolutely that transparency is a good thing, but as we said before, transparency and regulation they're not synonymous. They're not the same thing, right? Like there's one economist actually that stated there should be a reciprocation of access to data available to all market participants to ensure a level playing field. But does this mean that buy-side regulation is required? When you think about it, no, because if this is the case, it'll amount in a firm, let's take, for example, Walmart. Walmart then, therefore, would have to disclose its wholesale purchase prices. And there's no market in the world that exists like that. And so if you're saying that the government has to regulate by transparency, which it doesn't because, again, they're not synonymous, the full transparency, full disclosure would mean that these companies have to completely disclose what they're paying and what the derivatives are worth. And we can't do that. So, secondly, in response to the unequal competition and accountability, accountability is set within the contracts established between the two parties that are involved. There are always two parties, and they have a legally binding contract which states the obligations within a derivative. And by nature of derivatives, the products traded on the exchange must be standardized. OTC products have a bespoke terms agreement, and it's pre-negotiated. So a third-party regulation would only mess with that, and it would create inefficiencies. Also, the Dodd-Frank Act bailed out only certain banks, but not others. AIG was bailed out because their demise would be a huge impact on the global economy, and if government regulation was applied and they were to bail out certain firms, they wouldn't bail out every firm.
What's the definition of regulation, by the way? What would you do to regulate? Is the stock market regulated?
In certain aspects, yes.
Like what? What's an example of a regulation in the stock market?
Okay, well,
You have to file a prospectus.
just to get to your point of regulation, so you're talking about, we're not just talking about on the mean of just, maybe an example of regulation might be creating a disincentive, maybe capital gains tax, which we have in Canada. That's a regulation of the stock market, is that any returns that you make on some assets, such as stocks or bonds, you pay, and I'm not exactly sure the direct amount, but
I
there is a
didn't
capital
realize
gains tax.
that's what regulation is.
Well,
I thought regulation meant things like you must disclose your,
Well,
have a
that's-
prospectus.
that would be
Not
transparency.
passing.
That's transparency though.
Now to continue, but
What's another example of regulating?
Regu-
I'm wondering, when you say the derivative market should be regulated, what does regulated mean?
elimination. Well, what if all of a sudden you were to say, like, one day, government comes in, we do not want to allow credit default swaps. They created too much of a situation and a crisis in 2008 because there were too many tranches, too many people accountable.
And is that what you envision as regulation?
You mean?
He says regulation means.
Elimination or, yeah.
No, regulation does not equal to elimination.
What does it mean?
First, for example, regulation means the counterparty involved in the exchange or trade should disclose all their information like the price or the trading volume to
So if you
us-
give money to a hedge fund, you should know what the hell the hedge fund is investing in.
Yes.
But that's transparency, that's not regulation.
There's
regulation.
There's regulation of transparency.
Yeah, but that's already negotiated within the contracts of
No,
the two
because
parties.
in the derivatives market, there is no regulation push the hedge
There-
funds or
there's
the counterparties.
contracts
to
between
publish
individuals,
prices
which are
or
completely
trading
legal.
volume every day. So we don't know the market size of the derivatives.
Well, we don't need another market size. All we need to know is that I own this contract to buy that asset on February 25th, 2017. And I go, sign my name, and say,